me just introduce myself. My name is Richard Canvas. I'm part of the founding team at Pixie, and our business is focused on looking at patterns of behaviour that differentiate businesses that successfully scale from those that fail. And one of the most strident criteria are the types of decisions companies make about where they choose to fund their growth. And we've assembled. Well, I think this is the rocks. This is the. Well, that makes a huge difference, doesn't it? This is the rockstar team, I think, that we have assembled. Dr. Doyle, you're very modest. Let me just very briefly introduce the team that are here today. Alain Leroy from New York, who's the founder, managing director of venture philanthropy Blueprint. We've spoken quite a lot during the conference, and the business that he's up to is fascinating. It's very aligned with values that underpin investing. We'll hear from him. Dr. Dormatai, who's the CEO of Quomi. He's a healthcare founder and clinical professional, and his perspective, I think, is particularly interesting here because he navigates quite highly regulated environments and how that would play into a funding decision. Susan Daniel, morning.
Morning.
Susan's a consulting professional, I think it's fair to say. Advises institutions on governance and compliance and strategic development trajectory.
Yeah, spot on.
Very affectionate. That was the tough test. Amit, morning. How are you?
Good morning.
Amit is the GM worldwide and president of a company called White Clay. His particular focus is data, AI, and has a background which kind of spans the whole enterprise infrastructure right through to M&A and even exit strategy. So looking forward to hearing from you. And last but by no means least, probably our most hands-on practitioner, Mehdi Karumbooks, who is the COO of Aura Beauty app. We've checked in a bit already, and you have the most fascinating background going from operating within UK government and driving huge infrastructural projects, and somehow made the transition to starting your own business and being a founder. So there must be some learnings we can extract from that. I have promised that we will keep this sharp and snappy. This isn't a tutorial on how to raise capital. This is, I think, much more of a look into the sorts of the thoughts and decisions that you might make as you evaluate whether you want to grow your business from within your own resources and bootstrap it, or whether you need to reach outside and bring in external funding and the implications that goes with VC capital or other forms of institutional money. So we have some topics to explore. We're going to keep them quite quick, about a minute or so in each one. So with your permission, I'll launch in, and Alain, you're blessed with the first. So I mentioned that you're particularly interested in the alignment of values, and I wondered how founders should evaluate whether a potential investor actually aligns with their long-term vision, and how critical that is in terms of evaluating whether that money is good money to have in the business.
Great question. Is this working? No? Great question. Okay. Great question, and pleasure to be here, everyone. So my perspective today, as I sit here today, is my focus is around the entrepreneur that wants to make profit with purpose. So it's creating a business that is going to be profitable, scalable, and backable, but has an element of impact that's core to its business model. So it may not be that 10x return, it may not become a unicorn, but maybe it's going to reach 100 million ARR or even 10. But if we have a whole bunch of those, that portfolio is pretty powerful in making an impact in the communities. And in my experience, talking to a lot of younger entrepreneurs, 85% of them want to make an impact with their business. But the curriculum hasn't caught up to that thinking yet. So when you're looking for an investor or you're looking for resources and support, first of all, it's really important to have a full understanding of the problem that you're trying to solve with your business. And it really is important on, what stage are you, right, in that startup? and to align the capital that makes sense. And that usually in the beginning, it comes from friends and family. Um, some people don't have that friends and family to invest in their business. So it becomes more challenging. And then you need the support that you need to get to the stage where you are investable. So I think that the investor should be aligned with your mission.
I think that's this is a sort of message that I've heard repeatedly throughout the conference, and particularly how some of that narrative is evolving more towards the objective of impact rather than just maximising exit within a time frame or a multiple. Dr. Dorr, can I just sort of bring you in on this? So, is it a different investment vibe in regulated or in healthcare sectors? Are the considerations for you about how you fund your enterprises different because of the nature of the sector you're in?
Not really, because I mean you have the same options in Germany for finding funding or investors as you have anywhere else in the world. So you can come up with an idea, you can have a pitch deck, and you're selling it basically. So I've never really been one going into VC capital or angel investors, anything of the sort. I've been going more into straight out getting a loan from a bank and scaling from small to large.
So I guess that's a perspective from, say, the German marketplace, whereas access to those types of funding options might very well be different in the different markets which some of the founders here in this room operate. Do you have a thought as to a moment that you begin to think that external funding outstrips your ability to fund a business from a bootstrap point of view?
Obviously, I mean, if I really had, say, the guts, I would go and say, look, I've got a great product, I'm going to sell it. Give me 10 million and we're going to become partners. It's difficult for me to let go of the power play, having someone else involved. So this is why I always start off small with what I can and I start building up. All the private practices that we helped build up in Germany, for example, and even in Switzerland and other countries, we did a copy and paste system. It's quite simple. You start small with a small amount because you have to, it's your knowledge as a doctor or your biggest asset, which are your employees, on how far this office is going to lift off. Will patients come in? Will you have clients in that respect? So my opinion is always start small and keep building up. Now, if you really can take the pressure, you can go to the next bank, you can go to an angel investor and say, look, I'm going to build a clinic. Give me 10, 20 million.
This is a brilliant opportunity to reflect this back with Susan now, because there's a point, I guess, at which a business has reached a kind of a legitimate threshold where institutional investors will consider investing in either the vision or the product or however the model works. What typically do you see as being the sort of those key instruments of legitimacy that would bring in institutional investors into a growth business?
Yeah, interesting question. I was on the buy side many years ago before I became myself as an entrepreneur, founder, and CEO of my company or my firm. So typically what happens is that your institutional investor is hungry for deals that will last, and they don't just look at the cash or the return on investment. They want to make sure that also by them coming into your company, they have a great story to tell and a success story to tell. Because ultimately your institutional investors want to IPO your business eventually. So they tend to hunt for deals that people think that they always look at the financials. Financials is one element, but there are many other items or many other important and critical decisions that they need to make around what is this product? Where are you at? What's the life cycle of that product? Are you reaching a point where you think you're at the right time to go for investors? Then you also need to have a story to tell. Investors get really annoyed when they go into a company and all they see is that it's a family business and it's run like a family, and real decisions are not there. Governance is not there. Risk management, which is what I specialize in, is not there. the operational efficiencies are not there, are lacking. So they get really frustrated, and people tend to think that if I give you my audited financials, you should make a decision on that. That's not the case. They look at the quality of the management driving that company or that firm. They look at how the product has evolved. They look at what stage it is at. Then they go away and look at the entire team behind the decision making. They look at your policies, procedures. They look at your risk management team. They look at where are you in terms of regulatory compliance, because typically organizations that are very, very small tend to neglect some of the core elements of a decision.
I think that's, so we followed a sort of certain trajectory so far, I think, with this discussion. And I think what you're alluding to, Susan, there is almost the kind of the terror end of the spectrum for founders, because by the point we get to the subjects that your expertise plays into, we're into serious territory from a funding point of view. So that kind of neatly sort of, I think, explains the spectrum we're in here. I wanted to just get down a bit to the nitty-gritty, a bit more into the sort of, I suspect, some of the day-to-day thoughts that people are having that are in the room. And I mean, I'm going to throw this one at you. At a very practical level, everything is a cause and effect of everything. There's a cost benefit. What's your thoughts on, on the risks or the impacts of attempting to drive business from a bootstrap funding point of view, and what might be the consequences of not taking a more aggressive external funding strategy?
Debatable question and a tricky one. So I've been there.
You're the man.
Felt that, burnt my fingers. So what I would say is bootstrapping is not at all bad. But like what Alan said, it all depends on what stage you are in. There are certain costs, I would say, based on your question, which are not there on the balance sheet. And the first one is founder's time. So the founder's time is never there on the balance sheet.
Yeah.
You tend to wear a lot of hats. You tend to do a lot of things early on inside the company. And that kind of like doesn't feature on the balance sheet. Second cost, I would say, is talent trade-off. So talent trade-off is, you want to hire senior talent from the industry, and if you are not backed with VCs, you are unable to hire them. So that brings on to the third cost, which is speed and agility. So though you are convinced with grit as a founder or as a founding team, and you want to excel really, really fast, but at the end of the day, you don't have that fund which will drive you in parallel mode. You tend to do things sequentially. One experiment at a time, one market at a time, one hire at a time. So these are a few costs that I see. And I would say that, like Alan said, it all depends on what state are you in, at what stage are you in. And if you are convinced to go and get the funds in order to excel faster, I would say don't think too much about dilution. So go for it.
I think that's a really it's an interesting perspective, and I hadn't actually thought about it so clearly before. But this idea that that with limited resources, you're almost forced into a sequential path to scaling or growth, whereas by adding to the capital infrastructure of the business, that widens the lens and allows you to operate almost in parallel, bringing people, developing markets. So then I have to ask my good friend Mehdi over here about this subject, which I know is very dear to your heart, and that is, with all of these things considered, how do you weigh up the pros and cons of being the owner that controls the business against the owner that shares the control and the ownership of the business in exchange for some of the acceleration opportunities that bring in outside capitalism, and weigh up those?
Hello? Yeah, there we are. Thanks, Richard. Yeah. I think it just boils down to one question, and it's whether the founder, him or herself, would want to relinquish that control, their vision, essentially, versus scalability. You know, is it my company versus getting a big company? And I've spoken to hundreds of people over the past 12 months or so, or beauty, and everyone has an idea, you know, about how it should be run. These aren't investors; these are just, you know, people who just want to talk to me. And it's a case of like, okay, I think, you know, you should do this. Have you thought about this? Have you thought about that? Great ideas, of course, but it's not want all the beauty to it's our vision, our ethos. We have to stick to that ultimately. So yeah, I think there's a question there whether the founder wants to sort of relinquish that vision, their own vision, in order to scale up.
Do you see it, maybe as literal control? You know, a 4951 threshold where you literally don't control the business, or even having other people's opinions that came in from outside that need to be brought into the conversation as you think about the future. Where do you see the control sort of, you know, balance being tipped?
Yeah, absolutely. I think it's down to how the founder views their own company, you know. And I've spoken to founders who are just happy to provide that service and aren't really looking to scale up so much, you know, which is something that's to be respected ultimately. But we're in a business here, you know, everyone's investing in their time, their money, and the effort. So it's really a question of, you know, making the money while still preserving the service and the ethos that you're trying to create in the first instance. I think, you know, there's obviously, like you said, literal control, but also there's a situation where, for me, I think it's a case of getting investors to buy into your own vision. I think you sort of flip the script a little bit and say, well, you know, we just talked about here, trying to get investors to buy into your own vision. You know, if they're going to invest their time and money, well, we don't want something that's off the scale, basically. Yeah.
The risk of being slightly provocative, but I don't think investors can own the vision. You know, the vision must be the founders, because that's what the passion burns. Alan, let me bring us back to you, if you don't mind. You know, with a background in VC and as a management consultant, and having been around this, I mean, this is not your first rodeo by any long stretch. What are the pivotal moments when these sorts of thoughts do come into focus? And just share with me some examples of where you've seen good decisions being made and perhaps decisions that weren't quite so well founded.
Well, good question. I think, I mean, it's so, I think, first of all, it's a journey, right? So entrepreneurship is a journey. And I think from the perspective, I don't know if you want me to take it from the perspective of the founder or the investor.
I think from the general viewpoint, I mean, I think
Okay.
you've seen you've seen this question from both sides. So.
Right. So, you know, I think like from the perspective of the founder, this is a journey, right? So I think you have to ask yourself, are you you need an ATM machine. Now, is the business the ATM machine, or is are you creating an ATM machine in order to do what you really want to do, right? So a lot of entrepreneurs don't understand that sometimes it's not a direct route. So you need to have the support and the resources that you need to do what you truly want to be able to do. Now, for you to create that ATM machine, people have to want to invest in that ATM machine. And maybe that's all you want is the ATM machine. Or you need the ATM machine to supply you with the capital for you to do what you really want to do, right? And that may be confusing, but a lot of times when I speak to entrepreneurs, and they tend to be early stage, and I just help them to understand that this is a great business that you want to do. You validated your problem and your solution. In order for an investor to want to provide you with some capital, you have to be able to explain some things, like the problem that you're solving, How are you going to monetize that problem? They probably want you to be at least generating $10 million a year within 3 to 5 years. And that really challenges the entrepreneur to think about their business in a way where, how am I going to reach 10, at least from the United States, how am I going to reach $10 million a year? That means that you're generating like 3 million a month. That means you're generating, do the math, like per day, per week. That's a lot actually for an early stage entrepreneur. So it challenges you to think about your business model in a way and be a little probably more aggressive and have bigger dreams in how you're approaching the market.
I think I'm going to ask Mehdi to. I'm sorry, I'm coming straight back to you with this, because I'll tell you why I think this is fascinating. Is because I know that you're actually on the journey right now, and so within that sort of context, and you know, you're absolutely right. If you take the big number and you break it down into the small number, the daily number is still big, right? So, how's your thinking, Mehdi, as you're growing your business, and what are the milestones that you see where you might move from one posture from, say, you know, pure bootstrapping to maybe some angel investments, to maybe then going on and raising some more structured, institutional. What are your decision points and how do you feel about those looking forward?
Thank you. Yeah, good question. So we're bootstrapping at this moment in time, and I've spoken to investors, absolutely, and most of them said too early, which is fine for me. So I know my clear path. I'm not going to get investment at this moment in time, which is fine because it gives me that control we talked about earlier on. For me, I think I want to do things because we're launching the MVP hopefully early next year, sort of March, April. It's absolutely fine. I've spoken to app developers, and some of them said 3-4 months, some of them said 7 or 8 months. I've said, so long as it works, that's what we want. Doesn't matter how long it takes, that's absolutely fine. So, you know, I want our product to, when we roll it out, to actually do what it says we want it to do. So again, there's that element of control there. It's just sort of holding things back. And ultimately, if people want to, sort of external people want me to push that forward, I would always push back and say, well, no, that's not what we want to do. So, yeah, I think it's just a case of, at this moment in time, just I'm happy where we are and I've got that control. And then once we decide to market the product and get people to know about it, I don't need 10 or 20,000 people to know about my product. I just need 1,000 people to know about it. Simple as that. And that's with having a good, solid product to talk about.
You feel like you're in quite a comfortable posture right now, like you've got your hands on the reins, and the road view appears to be relatively clear in your mind.
Yes, absolutely. I think so. Yeah. So when we started Oral Beauty earlier this year, I thought I was quite arrogant. I said, "Oh, we're easily going to get investment because people, you know, everyone says, oh, we love your product." But it's all about numbers, as we know. It's all about traction. We didn't have any of that, and I've sort of made peace with that, and I've turned it around, saying, right, okay, not just making peace, but you know, that's good for me. It's a positive. Bootstrapping is a positive for me, and you know, when we do market the product, when we really roll it out, it'll just be a case of getting then people to help us market it, external funding that way. So we do have a clear route and a way forward. There's clarity. That's what we needed.
So Susan, I'm itching then to, you know, to kind of get you to extend that thought. It feels to me like the funding decisions as you go through the funding process, it's more like an architectural decision for the business. It kind of frames the strategy. So from a consulting point of view, from all range of your, you know, perspectives, how do you see this as being a positive weapon for a business to develop in a conscious way, evolve its architecture and evolve the way it runs its growth?
I think if you are an institutional investor, you want to hear that story. You want to hear the history to the entire organization when you and like I mentioned earlier, what frustrates an institutional investor is the lack of that. The tendency is that when you're looking at a specific company and you're trying to advise this as a company well worth investing in, the story behind it is where are we today, and what's the history to the organization, and how is it set up, how is it working, and institutional investors always look at how value is being created in that given organization, and they always are. They don't just simply want to part with the money, they also want to leave behind a legacy. And they always look for pockets where they can come in and help the founder establish themselves even better. What we've always advised founders is to, when you're at a stage where you think you're likely to be raising funding in the next 2 to 3 years, we always say, have you thought of having an advisory board? Get the advisory board in, engage in discussions with them, get them to understand. It's almost you're selling it to them before you sell it to a very aggressive institutional investor. The advisory board, what it does, it gives you the right direction. It tells you what you have and what you don't have. It's almost they give you a checklist to work from, tell you where you need to be focusing more on, and rather than actually just selling the product. And I think we're guilty as founders of the fact that we believe so much in our product. And I like what Elaine mentioned earlier was, what is the problem that you're trying to solve, rather than here's a great product, get in and buy it. As consultant, and also as being on the investor side, we hear so much of that, and then when we start digging into the more detail, we find there's nothing much in there. So it gets very frustrating, and it makes people walk away, makes your investor walk away, because they don't think you have really a solid case to tell.
Do you know, it's absolutely fascinating that you mentioned that. And amongst the 150 or so benchmarks that we use to essentially decode the scaling trajectory of businesses, one of the key markers is the existence of an advisory board.
Yeah.
And that's amplified if the members of those board have got a small interest in the success of the business.
Usually, yes.
It's one of the most unobvious opportunities for anyone who's got a business that they're looking to grow, and particularly then looking to draw in some heavy money into. Having a founding, we are so blessed at Pixie to have the most amazing advisory board. Every one of them has interest in the business, and the perspective they bring to us helping develop is beyond value. But aside from that, it is a very, very strong determinant of overall probability of being successful. So I genuinely couldn't, if you took anything away from today, in terms of thinking about some of the things that you might do at a practical level, give some serious thought to whether an advisory board would be helpful for you, because it will brings obligations with it, of course, as does anything that you take seriously. But it will genuinely have a positive impact, I think, on the outcome of your startup. Okay, I'm going to throw you the controversial bone here. So I think this is fair to say there's a certain image amongst founders' minds about what VCs are and what they bring, and the sort of, how do I phrase this? Their characteristics. Do you think this is a damaging misconception? How do you perceive the role of VCs and how they should be considered in the general ecosystem of growing businesses?
So, thank you for that question. And most of the answers were given by Susan. So, ideally, we perceive that the first thing that we perceive that VC is funding into is the product vision, the product strategy. What we forget, the VCs are funding, I mean this for the early stage and the mid stage ones. The VCs are funding into the founders and the confidence that the founders have, and the conviction that they have behind the product. Because when the VCs come in, they're going to push in the money, and product strategies will change. It's not that your product strategy on day one will remain on day 7. I've seen VCs, come in, pulling us into the boardrooms and changing what you felt was right in the beginning, because they carry that experience. They know what sells. Because when you are designing a product, you have not seen the market fully. You've been very theoretical. And like what Susan said, there are a lot of compliance which VCs get in. So the misconception that I'm going to continue the way I was or way I thought on day one is not going to be. The second thing is VCs. This is a misconception again, that VCs control your company. No, VCs don't control your company. VCs bring in a lot of guardrails. VCs bring in a lot of compliance, but they want you to freely do your business because they want you to do what you love. The day you stop loving your own business, I think it's time for you to exit.
I could not agree with you more thoroughly on that. But if the fire stops burning, it's time to put it out. Thank you. That's really interesting and quite refreshing actually from a very practical point of view. Dr. Dorr, it would be, if you don't mind, I'd like to give you the last word on this. I think we're in great danger of setting a record here by being on time. There's been a lot of discussion during the last 2 days, and I'm sure will continue today at this conference, about the mental well-being and the stress loads that founders find themselves under, and the extent to which founder burnout is a dimension of failure. One of the key forces of failure is if that fire stops burning for unhealthy reasons. So I'm very curious to hear what you have to say in your mind on the trade-offs from that point of view between growing a business with full control but bootstrapped, as opposed to bringing in, let's call it, more aggressive money that brings with it those extra burdens.
That's a very tough one to answer, really. So it's really it's a very personal question in the end, because everybody has to decide for himself when he's getting tired, when he's losing passion and the fire goes out, as you said. This is the point when that person really should take time out. Give yourself 3 days, a week, whatever. Really, the company will not go bankrupt in that time. And really just reflect. Leave everyone behind you. Just close the door. That's what I did, and all my colleagues did whenever they had a downtime. Everybody gets there eventually, I think. Reflect and then come back with either, okay, that's it, I'm closing shop, or I'm continuing. And then you decide, how are you going to continue? Can you still bootstrap, or are you going to go for a VC? VCs are really not bad. Out of my personal experience and people that we have advised with our company before, we're talking about different kinds of investing models. That's when the pressure rose. This is why I'm not very keen on external investors, because they came in, they said, I like what you're doing, I want you to scale up. We're buying part of it, or we're investing, which means we owe you partially. So you're going to work for us. So you've increased your workload, you've increased your pressure level. And this is when your environment changes and you're losing control, you're losing the fun in the matter, and you're stuck. Whereas if you did bootstrap that, then it's like 2 options: it works or it doesn't work. But it's your decision. There's no one else behind you. This is why I usually go for bootstrapping. Although in certain situations, yes, VCs are very welcome, definitely. And I think it's a great idea, especially in certain areas of the world where you can't just get a bank loan. You can't just go to your neighbors, or your parents. So you definitely get a VC. And some of them are really, really good and very helpful. And there's microcredits and whatever else. Your psychological state is very important. If you have a good day, the company runs mint. If you have a really, really bad day, your shares will go down, right? I mean, it's such an influence that you really have to reconsider it every single time, and take that time. Really, just give yourself a little bit of space. I think you know what I'm talking about.
So I totally agree with Dr. Matai. And so if you look at the topic, it says bootstrap to venture capital. So the journey from bootstrap to venture capital, there are a lot of things in between, even from a funding perspective. So what I would suggest is for all early stage startups to find an angel. An angel is somebody who actually gets you onto that VC roadmap and also helps you with your vision. So an angel could be your own partner, founding partner. Your angel could be your own family, or an angel could be an outsider who actually brings in that perspective, a third vision to the vision that you have. So
I could be itching.
Yeah, no,
Jump
I just,
in,
I
please.
just wanted to say that, the stage you're in really, really, really matters, right? So I think that when you reach a place where you figured out how to solve the problem you're trying to solve, like you've experimented, you've researched, you have a pilot that's out, you got enough customer feedback and discovery where you have a level of confidence to walk into a room and tell somebody writing checks, I know this is what I found out. I spoke to 100 people. We actually have something out that proves. Now you're in a whole different position to have more control over how you're going to spend the money that you may receive. If on the other side, you're at a state where, man, I need to run more experiments, I need to do more research, and I need some capital to be able to do that, that's a different kind of investor, right? So I think you just have to be careful because at that early stage, it's probably somebody that's more, they're betting on you as a person. They believe in your conviction, your passion. They believe you are the right person to figure out how to solve that problem. They may not be looking for a 10x return. They're just really trying to support you, as opposed to at the latter stage where you're reaching potentially a VC or an institutional investor. They want to make sure that the math is going to work out. They want to make sure they're getting a 5-10x return on their investment. So I think it just matters, right? And I think last part is that at that early stage, there could be a way for you to get people to support you without having to receive financial capital, right? There could be human capital. There could be friends or interns or college students, or there could be a way for you to get the support that you need, but they have to rally around your vision for what you're trying to do.
Interesting. I think that's. I see what we're going to do. We have an extraordinary cross section of experience, perspectives, expertise. I think that's been very clear, certainly to me. We have, like the Oscars, a few minutes left. So before I thank my family, I'm just going to say now's the opportunity for anybody out here. I mean, I can't believe how people are here, which is fantastic. If you have any questions from the audience that you'd like to put to the panel, please now, love to hear from you. Sir.
This question is for Alan. I love what you said about profit and purpose. And are you based in the United States?
Yes.
Okay, a couple things. I'd love for you to be my mentor. And I'm stepping out on the ledge and asking for that. You align in the vision of Colorful Voices, but so that's my statement. My question is, what is the question I should ask you right now that I don't know?
There's 5 questions.
Just 5.
I don't know what you don't know. So first of all, I need to talk to you for 2 minutes to understand what question to ask you. But there's 5 questions. that every entrepreneur needs to be able to answer. And they're going to come to you, and they may not be phrased the same exact way, right? I gave you 2 of those questions today. What problem are you solving? How do you plan on monetizing that problem? There's 3 more questions. I'm not going to give it away right now. Reach out to me, catch me on LinkedIn, whatever. But that's really important. And again, what I said earlier, just before you asked that question, is really important. It's a journey as an entrepreneur, and depending on where you are in that journey, you have a set of goals and you have a destination, and there's some pit stops along the way. So I think you just have to really take it one step at a time. You have to understand the big picture of where you're trying to go, but then you have to take that next step. And the people and the support that you need to take that next step could be different in that first step versus that fifth step.
Thank you so much.
All right.
It's gone red down here, which means I'm probably in trouble. Can we take a couple more questions? Does anybody have any more questions that we could take from the floor whilst I have my panel here? So I'll see these slides. Sir. I think we might be all done. Let me just please wrap up by saying thank you so much for everybody coming, all of you. It's quite extraordinary. And I mean, what can I say? Thank you so much, panel. It's been a pleasure working with you on the run-up to this. I think I've made some friends for life, and I appreciate the time and effort you've put into this. So I'd like to please, on behalf of the audience, thank you very much for your contributions. Thank you.
Thank you.